Well, our current euro-dollar forecast for the end of the year is 126. So that implies about a 5.5% drop for the US dollar on a DXY basis. And after last week, I'll have to admit that's perhaps a bit of a stretch. So I think we are going to have to raise our dollar forecasts against a lot of the G10 space and the emerging markets. But I don't think we're on a path of sustained dollar strength. We have had a jump in the dollar, but I still think going forward, we're in perhaps a range rather than the beginning of a sustained move stronger. And that's been a lot of questions put to me since the Fed meeting. Is the dollar now on a path of strength? And my answer has been, no, it's not. And I think there's a number of reasons for me reaching that conclusion. I think firstly, the Fed simply don't want that. You know, the link between the US dollar, inflation expectations, real yields, asset prices, all of those are interlinked. And if we were to start to get a sustained leg higher for the US dollar, I think that would have real implications for inflation expectations. The 10-year break-even has already dropped quite notably since the meeting. And I think it would put real doubt on the achievement of the Fed's new inflation averaging target, where they're implying to the markets that they want to have a higher level of inflation for a period of time going forward. So I think the Fed will do as much as possible to kind of balance up the market in terms of what their goals are going forward and how the reaction function will still be quite cautious. Secondly, we still think we're in a global reflation period. Yes, a lot of good news is priced, but global growth is set to remain quite resilient this year and in 2022. So the IMF, for example, they have a forecast of 6% this year, but still a very robust 4.4% next year. So I think the reflation trade, that appetite for rotation out of the US dollar into non-dollar currencies as global growth remains strong, I still think that's a valid expectation going forward, and that of course should keep the dollar in check. And then finally, a lot of comparison has been made to the well-known taper tantrum of 2013-2014, that perhaps the Fed is doing the same again now, except with the dots rather than with tapering guidance. But we have to remember the dollar back in 2013-2014 was considerably weaker than where we are today. In fact, compared to today's broad dollar index measured by the Federal Reserve, the US dollar is nearly 23% stronger than we were back in 2013. So in other words, the scope for sustained dollar strength going forward from here, I think is a lot more limited. And again, I think that means we're in for a different response to this Fed event than what happened in the taper tantrum in 2013. I don't think we should expect as big a shock as what the FOMC provided last week, but certainly the Bank of England could shift a little bit more hawkishly. That's definitely the risk. This is Andy Haldane, the chief economist's last meeting. We know his position. He's voted against continued quantitative easing. He will likely vote for a 50 billion cut in the total fund. But the rest of the MPC, I think, will probably remain broadly unified. But we have to acknowledge that both GDP and inflation are running ahead of what the Bank of England expected. On GDP, the Bank of England expects 4.3% quarter-on-quarter growth in Q2. By the end of April, we were already at 4% quarter-on-quarter growth. And even moderate 1% growth on average in May and June, we're going to have quarter-on-quarter growth of 5%. So clearly, very likely, I think we're going to get stronger growth than what the Bank of England expected. Similarly on inflation, we're already at 1.77% versus 1.69% from the Bank of England. Not as big a divergence perhaps, but certainly inflation and growth looking stronger than what the bank expected. So the bias in the minutes is likely to acknowledge those risks, and therefore there could be a hawkish tilt to the overall tone. But I wouldn't expect an aggressive shift. But certainly, you know, short-term rates are creeping higher, partly helped from the Fed last week, of course, but certainly markets beginning to consider second half of 2022, Q4 2022 certainly, that's where we feel there's a good chance we could get the first rate increase from the Bank of England. And I don't think there's going to be anything to question that market expectation. And therefore, short-term rates should remain well supported, and I think that will certainly help to provide support for the pound also.